So the goal is simple. I want £1 million in a dividend portfolio by the time I'm 50. I'm currently 34. So a couple of months ago, I shared my holdings, but since then, I've done a lot of changes. And due to you guys, in terms of the comments, you made some very good points and I have changed it. So I think it's best to do a video going through it all. I've added some new stocks. I've reduced a lot of the underperformers slash low yields. I've added some new stocks. I've removed some stocks. I've also added a bulk of it with ETFs, which will make the goal more achievable. I think in the original video, it was like a 2.6% yield. That is almost double now. So yes, we'll walk through it all in fine detail, every single stock, the whole analysis, the stock ratings, everything, because this should give you a much bigger insight and I will not be moving it around much. I will be just investing hard. And if you like this sort of stuff, please do hit that subscribe button and leave a like and comment what you think. It is a long one. Please stick with it, but I will be going through the entire portfolio, the whole data, the whole information, and why we are on track to achieve the goal. Now, before we start, obviously, this is not financial advice. What I will be talking about is my own personal money. It is my own personal journey in my portfolio. I'm just showcasing it. So yeah, feel free, as I say, comment below with any sort of pointers. Now, the first one is kind of an obvious one, really. It's one that has not changed and probably won't change because it's a good one. I will be doing a video based on this platform in the next couple of months, potentially, because I want to set up a junior ISA. I feel like there's a lot of about that. So I need to get my head around it and open up a platform. But I will be using this to open up a platform on the junior ISA side for my kids. But let's talk about the stock itself. This is Stockopedia. There's a link to this below, 25% off if you are interested. It's a fantastic platform. You'll probably see me using it an awful lot. Now, the numbers of this platform are really good. Put it that way. It is literally, apart from the value side, which you can argue maybe a little bit overvalued, but if you're a long-term holder, it's not too bad. But in terms of the financials, in terms of the dividend growth, it just dominates at the minute. And the growth cargo of the compound annual growth rate, all of that ticks so many boxes. And overall, as you can see, the revenue really solid. The reality of all the operating costs and everything, cash flow, the lot, it is looking so much better than most other platforms out there. The dividend growth just chilling, just trickling along very, very nicely, and the yield is doing its thing. So this is one of my lower yield ones, but ultimately it's doing really well. So I'm pretty happy with this personally. But yeah, if you don't know what this is, I hope you should if you're in the finance world. It's AJ Bell. As I say, looking to use it. It's winning multiple awards for their ISAs and their pensions and stuff like that. But yeah, I will be looking to set up at some point very, very soon for my children this bad boy, a junior ISA. Whether I talk about it in terms of monetary value or not, or how they work, I'll need to figure it all out. But ultimately, it's probably the most obvious one out there for me to use, and it feels like an obvious bet, and that's probably why I'm investing it. But as I say, it's a nice blend of growth and income. It's in a sector that we all know, and it seems like a really obvious one in my viewpoint. Now, the next one is Aviva, a very obvious pick in my viewpoint. It's one of the leading in terms of UK dividend portfolios. It's actually got, even though there's a lot of red there, there's actually a decent amount of strong cash flow. And more importantly, it's a thing that you've all heard of. It's insurance, essentially, right? But it's not the fastest grower, but it is actually quite reliable in the income sense. Now, as you can see in terms of the scores, it's not amazing in terms of like the value right now. It's obviously take a bit of a hit, and value-wise, it's quite all right in terms of value. But that being said, there's a lot of numbers here that are okay, and there's a lot of numbers that are not okay. But let's go through it. Firstly, the total revenue is looking to rise over the next coming years, which is an interesting point, and we can see that and look at that and think, okay, it had a little bit of a rough period over the last couple of years, obviously with COVID as well, probably a big factor in that. But as you can see here, for the last 6 months, Aviva has increased its revenue by 15%. There's been a lot of interest around obviously insurances and why certain things are happening in the world and certain things are happening, but this actually hasn't been too bad. And, net income was offset by general insurance segment income decreased by 26%. So there's been a lot of to and fro in between certain things, but even with that, they still managed to raise their dividend and stuff like that. But ultimately, over the course of time, you can see in terms of the estimates, we're looking to go up again. So you can argue a couple of things here. So it's not bad in terms of the growth. In terms of the industry, it's really high for the dividend side, and the dividend is really reliable. It's like 7% across the board. Dividend yield looking pretty healthy over the course of time. And again, it's a staple of the UK. It's one of the most obvious things you'd look at. If you're thinking insurance, you probably will see an Aviva advert somewhere along the line. So it just seems like an obvious one for me. And as I say, we talk about insurance. UK's leading diversified, insurance broker essentially. They do everything, literally everything. And if you need insurance, if you're looking at the world of investing and all the gubbins and that, it's all here. And again, we talk about dividends, and it's one of the strongest dividend companies you can get in the UK in terms of its growth. We're looking at potentially 6% plus yield in the next year or so. So that is relatively good as well. The price is pretty stable. Now, BAE Systems. Now, if you don't know anything about me, I was in the military. I was in the military for 6 years. I was investing in the military, and I came out of the military and I invested in a lot of things, and I did fantastically well. Hence why I'm full time in the world of finance. Now, let's talk about it. BAE Systems is one of the most obvious picks out there in my viewpoint, not financial advice, because of what it is. Now, I had a comment on one of my videos recently why it wasn't technically a super stock, or, in terms of 90 plus on one of my videos I did recently, because the value is quite low, i.e., it has done so well in terms of momentum and price performance because there's a lot of wars going on. Just going to say it. Wars are one of the things that will ultimately pay this bill because it is defense, essentially, right? But numbers are good all over the place. The growth CAGR of the dividend is good. We're looking at a decent dividend yield coming up in the next future. And this is one of the ones that I'm one of my lower dividend yield ones, but a really strong overall company. There's a lot of people that want to buy and keep buying this in terms of the consensus between the analysts. And the numbers are just all positive, pretty much. And that's the situation that we're looking at here. It is very, very positive. But as I say, it's an interesting one, obviously, because of what it is. A lot of people may not like it, but it is a solid performer. And again, we're talking about what is it? It is defense, essentially, right? A gazillion employees, you got, the military, 40 different countries, military capability, protecting national security. I remember being on firing ranges, seeing these boxes all the time with ammo in them, all that kind of stuff. There's so much out there, but it seems like, in my viewpoint, one of the most stable and obvious picks if you're thinking for country infrastructure, so to speak. So it's an obvious one. Obviously, not everyone may agree with me on that one, but I know a lot of people in the comments have been talking a lot about this one. It's just an obvious one. Now, one of the big omissions of my last video regarding, well, what did I have? I didn't have any ETFs and I didn't have any trust funds. This was an obvious trust fund. It's not an amazing trust fund. It's all right. I will showcase what's in it. It's kind of like a miniature ETF in a way. Doesn't have the best performance data on this website. There's a lot of like iffy kind of data, and I would take it with a pinch of salt. Obviously, the coronavirus created a bit of a problem. It has recovered somewhat, but not amazing. However, if you're wondering what's in it, if you go on the Fidelity website, you can look at the overall trust essentially in terms of the performance, but ultimately its entire allocation. 91% of it is essentially in the UK. And it's kind of, yeah, it's the obvious in the room. Some of these I do hold myself, or I did hold, but that's what I mean. Like, it's kind of just like a trust fund, which they manage it, and performance of these will obviously will perform better for this trust fund essentially. But yeah, City of London, it's kind of one of the most obvious ones in my viewpoint just to jump into. Not the best in terms of price performance over the last couple of months, but ultimately it's okay over the course of time. It has been pretty good, as you can see. So it's quite slow, it's progressive, but ultimately it does pay a growing dividend yield, which is important, and that's what we kind of want here. It's a little bit lower than what it was, but it's steady away. It could be a hell of a lot worse, but it will depend on what they're holding, obviously. If there's been some negative action there, but ultimately, as you say, with likes of a trust fund, you're kind of not all at one favor. But, overall, it's not terrible. Now, another top stock in my viewpoint, high on the quality, high on momentum, is Coca-Cola HBC. Basically, long story short, the bottling company for all of the Coca-Cola company. It ticks all the boxes, literally. So revenue is flying through the roof, as you can see. A lot of growth there. Operational profit is increasing, cash flow is increasing. The dividend growth is highly consistent, very consistent, and probably a really solid hold. Yeah, it just, as you can see, it ticks all the boxes, and most people will know exactly what it is. Again, we can talk about certain situations, and we can talk about how its revenue has increased over the course of every single emerging segment of their business. Every single one has increased, which is massive. When you think about how the world has somewhat changed around Coca-Cola and sugar and all that kind of stuff, it's still performing fantastically well. But as I say, yes, it's one of those ones. It's in multiple different countries. It's around the whole entire globe. It's one of the most obvious kind of plays. If you understand the brand Coca-Cola and what they actually own as subdivisions or whatever it may be, it's just an obvious exposure. It's, how many people buy Coke in the world in every environment, they always will. So it's one of those things, even when we talk about Sprite and Fanta and all that kind of stuff, it's kind of like the most obvious pick in the world. So yeah, it's just there. Now, another interesting one is Diploma. Really good price action, a really quality rated company in terms of health, and momentum is strong. It's pretty good, realistically, and you'll see this pretty quickly. Its revenues are just flying through the roof. Its dividend yield is pretty consistent. It's one of the lower paying ones, but it's one of the ones that will fit anyone's portfolio for dividend growth. And it's a really obvious one in terms of everything. Its revenue has been skyrocketing over the last couple of years, and you can see that very clearly. Even on stuff like life science, like segment is increased by 1%, which is 110, sorry, million. So there's stuff happening, massive increases across the entire company. But in terms of what it is, it's obviously a huge part of life. It does a lot of control mechanisms, does a lot of seal mechanisms, life sciences. It's probably one of the ones that like you probably never heard of, but you probably know of in terms of if you're working in the factories and stuff like that. It's just a monster in terms of behind the scenes for critical parts of engineering. Just to give you a bit of an idea, the control side of it delivers a wide range of products, technically demanding applications across broad end markets, including aerospace, infrastructure, energy, rail, and medical. And as you can see, it'll just go on and on and on and on. And this is the thing, it's kind of like the fundamental element of why countries work with stuff like this. Now, Drax is a really good one as well for overall dividend growth, but also for what it is. It's quite a good one. It is a super stock, even though they have had a little bit of a fall in revenue. They're still absolutely fine, but ultimately, Drax is a massive power plant in the middle of the UK that does a lot of biofuel and pellets and stuff like that, which is really, really good for the longer term. And it does power quite a lot of the country, realistically. Now, as I say, we're talking dividends and dividend growth. It's probably one of the most obvious ones out there in my viewpoint in terms of how good it is. You can see over the course of time, especially since obviously some of these random ones at the start, but over the last couple of years, it has been really, really growing very, very nicely. But ultimately, as I say, it's one of those companies where you think that's kind of an obvious one. It's kind of a really good pick. So as I say, Drax is in the middle of the UK. Essentially, it is a monster power plant. It powers quite a decent percent of the UK, and yeah, you could argue some of the revenues have fallen, but ultimately, the world of biofuels and the pellets that they use is relatively good and good for the longer term. But yeah, you can see here Drax is leading dispatchable renewable power in the UK, delivering 5% of the UK's power, significantly more than the system needs. So yeah, it's one there. It's an obvious one. It's huge infrastructure in the UK, and if you are an investor, I mean, you should really be having something like that, especially with that dividend. It's pretty decent. Now, Halma is a quiet compounder focusing on safety, medical, and environmental technologies, and has got a really good track record for dividends. But it's not very flashy. It doesn't have the biggest yield. It has quite low value on this metric because it has performed really well in terms of price. But as you can see here, in terms of revenues and the growth, it is growing very, very nicely. Dividend growth is growing nicely as well. And over the next couple of years, it could actually be churning out a couple of percentage points, which would be quite good on the yield on cost side of it. But at the end of the day, it is quite, I wouldn't say niche, but it's one of those ones where it's a sort of thing where you're only going for the numbers because you may not understand fully what the technology is essentially. So as I say, it's growing a safer, cleaner, healthier future for everyone every day. It's a group of small companies that specialize in certain things, and you can see here some of the specializations are pretty crazy. And as I said before at the start of this, we're talking about safety, medical, and environmental technologies here. It's a bit of a shift. It's a bit of a one that's wild and out there that could be quite an emerging market. But you can see here, built for growth. They've, 7 acquisitions over the course of 2025. It's in 100 plus countries. Consecutive profit, 22 years. So it's one of those ones where, as I say, it's relatively niche, but it's proven to be a really good business model here. Targets global niches in markets with long-term growth drivers. So what they're doing is definitely working. Now, Hikma. This is, well, healthcare essentially. It's the exposure to that. It's pretty balanced and it has a steady dividend growth. Doesn't have the best momentum at the minute, as you can see on the screen here, but price is only a price for so long. At the end of the day, in terms of the overall growth of this ecosystem in the industry, it's going to come under some cyclical kind of elements because it is healthcare. As you can see, the revenue is actually growing, but ultimately the net profit has taken a bit of a drop here. But overall, the dividends are still very, very strong. We're talking about some really good average returns, which is relatively good. The dividend growth CAGR is still, industry led pretty much at the peak there. So that is a relatively good one. But yeah, certain things have happened here. You can see that revenues have increased a little bit. Net income has increased as well. But you could maybe argue with the situation around tariffs in the US, we may fall down a little bit there. But overall, it's a pretty solid one. But as I say, it is the obvious kind of exposure to the healthcare, and it is still compounding some pretty steady dividend growth, which is what most people want. And it is, a lot, it's not massively cyclical versus some of the other healthcare ones. I've seen some healthcare stuff go literally into the gutter pretty quickly based off certain news and announcements. So certainly quite an all right one, realistically. Now, Hilton Food Group. Now, these supply a lot of supermarkets. They are a steady demand, a strong contracts on a lot of companies you've probably heard of, and they are all across Europe, as well as the fact that they are a steady dividend growth company. Momentum's quite low in terms of price, which is okay. It reduces the score a little bit, but the quality of the overall stock's pretty good. Now, that's what you want. You want a solid company, and you can see there with all the black numbers, it's looking relatively good. And the overall growth is looking good. The dividend yield as well, the dividend growth is pretty strong as well. And everything's doing all right, even with the revenues remain flat, which is fine. But there has been a net income increase of 8%, which is pretty good. So overall, across, there's been a lot of good increases, which is kind of what you want, and that's what you need realistically from a company like this. But as I say, it is a massive distributor of food. It brings a lot of stuff happening around the world, across Europe, for the food market, which is kind of what you want, obviously. But again, we're talking about 7,500 employees. You got billions in terms of turnover. 24 modern facilities, which is crazy, and 13 markets worldwide, from meat, seafood, the lot. And when we go down a little bit further in terms of, partnerships, Costco, Tesco, obviously, you got everywhere, Ocado, Waitrose, you got ones in, other countries, obviously. You can't really not look at this and go, yeah, I get it. I need this. But the thing is, with companies like this, you kind of spot for choice. There is other ones out there. There's British Association Food, which is what I mentioned the other day. There's so many out there. If you're thinking the backbone of countries, stuff like this should tick all the boxes. Now, remember the word ETF. Now, I was very much, I wouldn't say against ETFs, but I wasn't fully convinced at the time. But I've changed and done a massive 360. This is one of my ETFs. This is the ETF with the broadest exposure to the higher yield UK stocks. It's not relying on my individual picks. It kind of smooths it out. And my weights, I have put a link below in terms of the video to my Trading 212 Pies. If you want to copy and follow along, you can. But it's 20%, which is a good one. Now, let's talk about it. The overall price performance of this ETF is relatively strong and has no doubt been a really, really strong staple for a lot of people's portfolios. In terms of the dividends as well, relatively good. Yeah, it goes up and down in terms of yield, which is fine. But more often than not, it's actually relatively steady, 5.12%, which is pretty good. And the holdings are kind of what you expect, 93% of it in the UK, which is good, and diversified, which is what you kind of want. You want it to take most of the bulk of the heavy lifting for you, and this one does. So yeah, it's kind of the most obvious one out there. So another obvious pick kind of is the outsourcing facility management of government and, public and private sector, essentially governments. Mitie, right? It's across the world, but it's also across the UK as well, quite heavily. And it's got a really good dividend yield. It's got really good, overall revenue. As you can see here, it is increasing. There has been a little bit of an income loss at certain points, but it has actually made a lot of income in terms of increases, as you can see via this situation here. By 14% revenues have increased, even though there has been a decrease in their net income. It actually states that it was offset by some changes as well. So it's one of those. It's why it's doing really well. Industry led elements around the growth compound rate is up through the roof, is looking relatively strong. And there are a lot of black numbers there, and it is looking really, really strong. Now, in terms of what it is, as I've alluded to it before, it is UK leading management facilities. And it does a lot of cleaning contracts, engineering, integrated facilities, stuff such as technology, projects, security, the lot. It does everything. And it kind of is like one of the backbones of the UK if you're thinking about government led contracts, especially if you're in the military, if hospitals, whatever it may be. It's up there, and you probably have seen that logo kicking about all over the place. It's everywhere. And yeah, 3,000 plus customers, a decent chunk of revenue, everything up there. And even looking at the careers such as customer service, energy, maintenance, and technical stuff, detention, custody, all that kind of stuff, business development, operations, bit of everything, really, isn't it? Now then, the national grid. Now, not everyone likes this, but for me, it just feels like an obvious utility that kind of powers the country. Revenue's not amazing, coming down a little bit from 2023, but ultimately everything else is looking relatively okay. The dividend is actually all right. It has had a bit of a negativity over the course of this year, but nothing too alarming that's going to make you, jump out essentially. But sometimes you get massive growth, sometimes you need a bit of a decrease as well. Overall, though, it's okay. It's not amazing. It does need a bit better dividend growth, but I'm not worried about it overall. As you can see here, I mentioned it just before, the revenues has decreased a little bit, but there has been a massive income in, weirdly, the net income. So there's a situation where some stuff's increased, some stuff has decreased, but overall, I don't think it's changed much in terms of the overall picture, but net profit has increased quite a lot. So yeah, it's kind of an obvious one. But as I say, the UK infrastructure of delivering electricity and gas and all that kind of stuff is kind of going through a little bit of a change in terms of how people obviously wiring and doing their homes nowadays. But ultimately, I can't see the national grid going anywhere anytime soon, personal opinion. But yeah, it's kind of like a mainstay. Now, Phoenix Group is one of my latest ones. It is quite a high yield one. Dividend plays a big part in it, but it has had a huge turnaround recently in terms of its performance of price and stuff like that. And the momentum is pretty good. It does need a lot of work in terms of the overall revenue, but it is slowly starting to claw back some of that revenue, which is what you kind of want, but it is a bit risky. Ultimately, it depends on so many factors. But as you can see here, the dividend growth and stuff like that is still happening. But as you can see here, over the course of the year recently, an increase of 7% in terms of, revenue, which is pretty good. So there has been a net loss of common stock totaling 1.12 billion versus income, but there has been an increase in certain things. So it's one of those ones where it seems to be like doing a bit of a turnaround. It's starting to get it's shit in a sock and it's starting to improve a little bit, but investments have increased. So yeah, there's been some good stuff, but not amazing. It does need a bit of time though. However, a lot more brokers are starting to hold it and buy it now. And as you can see with the overall score, the value's all right. The quality is starting to increase, but the revenue is pretty much looking all right. However, it is now showcased as a turnaround. So keep an eye on it. But it is a company around pensions, retirements, and all that kind of stuff. And as you can see here, it's one of those kind of companies where you kind of look at it and go, we need this in the country, such as the likes of Standard Life, Sun Life, and all these kind of stuff. And that's the thing. It's one of those backbones where People are getting older, savings, life insurances, all that kind of stuff. And overall, you can see the numbers are all right. Let's be honest, 12 million customers, all that kind of stuff. And that's a situation like it is turning around, maybe some better decision making. I've not been a holder for long, so I don't fully understand what's changed versus over the last few years. But I just see this like Aviva. You need something like this in your portfolio that will help, grow over time because realistically, it's needed. Now, another new one, Smith's News. It's mad. Let me explain it. It's a good one, but it's a small cap with massive dividend punch. It's distributing newspapers and magazines. It's very niche. The yield is attractive, but it kind of is the bread and butter and the backbone of the UK in terms of obvious society of going to the news agents, picking up your paper and going home and reading it, right? But they also do a lot of recycling stuff and other elements around deliveries and stuff, which is quite big when you think about the overall metric. It's actually known on this website as a super stock because of its metrics, and it's actually doing relatively well overall in terms of performance. And even though like revenue's down a little bit, but net profit is actually up, the dividends are into some silly numbers and actually compounding very, very nicely. It had a bit of an issue over during obviously COVID and stuff like that, but overall, it's actually relatively good. And, I can't really see any negatives about this as a low cap stock. And yeah, the price performance isn't amazing, but the yield is pretty good. And you could probably argue pretty reliable because you understand the industry. Obviously, yes, if we get another kind of pandemic kicking about, it's going to be a bit of an issue, obviously. But do we see that happening anytime soon? Probably not. No. So yeah, it's a really really solid one in my viewpoint. It seems pretty good fun. And as I say, like if you're a retailer or if you've seen these sort of retail kind of um shops out there, they do a lot of things. And as you can see here, warehouse services, deliveries, storage, distribution, printing, all that kind of stuff. It's just, yeah, it's one of those, isn't it? Even though we can argue potentially, yes, the world of newspaper and magazine is kind of evolving and changing, but it's still here. Now, another obvious one, and for me, it's just a UK classic, really. And people need food, they need shopping, and whatever the economy does, unfortunately, people will still need to eat. That's just the way it is. And you can argue a couple of things with Tesco. It had a rough couple of years, about a decade ago, but it has improved massively, and their revenue is just growing, growing, growing. And that's what you kind of want in a stock, realistically. And even though the dividends are quite attractive for a lot of people, they are still growing as well. Not amazing. It could be a lot better in certain points, but as you can see here, like there's just overall, it's just growing, growing, growing. Revenues have increased. You know, can't really complain. Let's be honest here, and it is starting to get a lot more coverage online and stuff like that about what they're doing. But yeah, Tesco just seems like an obvious pick. It's a place where I do my shopping personally. The club card situation's getting better and better. I feel, anyways. And overall, you can see the 2025 highlights. The sales are up. The adjusted profit is up. You got free cash flow still. You got less net debt. Everything just seems to be better. And the final one is an ETF, the Vanguard FTSE 100. Pretty simple. It's low cost exposure to the UK's biggest companies, and it adds some stability to the other ETF, which is 20% and also 20% here as well. Decent price performance, really low cost. And yeah, as you can see, the performance overall over the course of this year has been pretty steady away. Can't really grumble. Can't at all. Again, similar sort of holdings, mostly the UK, decent amount of like spread across the top 100, exposure to a lot of things. Overall performance, relatively good. Decent dividend yield, 3.22%. It is lower than what it was in the previous years, but it is still pretty good. And the volatility of it, pretty all right. It could be a lot worse. And as I say, you got multiple different stocks here. Where are they gone? I've lost them somewhere. There we go. Holdings. Yeah, they're all there. Pretty good. Pretty good stocks. And I can't really complain much about this one, to be fair. So in terms of the overall metrics, and this is the overall portfolio, this is where we are right now. This is fully updated. It displays the numbers much better now than what it was. 4.28% in terms of the passive side of it. Yield on cost is a bit higher than that. Not much though, but again, it depends on what your opinion is on it. Obviously, it's quite a new portfolio, so this is not going to change much at the minute, but 4.31%. But as you can see there below, the diversification, the profit side of it is a lot of it is in the ETFs, obviously. Phoenix and Smith's pretty high, and then obviously you've got the likes of Aviva, and everything else is pretty consistent, along with a couple of other ones at the low ends here. But some of the low end ones have got really high dividend growth that could do really, really well longer term. And the reason why I say that is because we've got 9.9% dividend growth on a lot of these. Some of them we don't, which is fine, but some of the obvious ones up there. So it's quite balanced. I've got a bit of dividend growth and I've got a bit of dividend for now, or dividend yield for now, and then some growth in there as well. And obviously a lot of that with the counterweight of the ETFs. But as I've said before in previous videos, we're looking at some pretty lofty numbers for a overall portfolio of being pretty safe. Now, if we're talking about what crazy targets we could be getting, even right in 2038, which isn't that far away, let's be honest here, I could be looking at some lofty numbers if I am still contributing that 1,666 per month. But by 2040, we could be looking at pretty much the portfolio of in and around 1 million. If we're looking at the safe version, which is a lot lower returns in terms of this on here, we could be just below it, but it just depends. But for me, by 2040, I will be 49 years old. So I'm kind of, give or take, on that kind of level. It's quite a hard one to obviously kind of quantify, but ultimately, again, if we're going to look at what these numbers are and all these kind of expansions and safe portfolio and whatnot, yeah, you could be arguing, what it could be in terms of overall price metrics and what could blow up. But more often than not, you could probably argue we may well get decent returns. But even at 10% with a safe version, we're still looking not far away. And even at 2041, I will be 50. But obviously, this doesn't really include inflation, which is somewhat of an issue, which could kind of hinder it or make it better. Who knows? Because £1 million, let's be honest, doesn't really go very far. In terms of the passive income side, I think this is a lot more important for some people, but overall, the growth of the portfolio and the yield right now, I always say I want to hit £20,000 per year, because that would hopefully double my contribution. If I'm still able to put 20 grand in per year, that would be nice to make that and obviously double it. If we're talking about overall metrics and we're talking about where we could be, the portfolio could be returning roughly around £18,000 to £22,000 in 10 years, which is mad. So by the time I'm 42 or 43, I will be earning roughly 18 to 21,000 in passive income on the dividends, with a portfolio that have hopefully compounded and reinvested that money every single year. That's pretty crazy. And that is probably where the compound will start. Because let's be honest here, if we're looking at silly numbers and investments and retirements, I mean, that's just boggling to think like how you could be growing that quickly. But by the way, if you are interested in this platform as well, there's a link below. You can save 10%. I'm pretty sure there's a big offer coming on in September where you can probably save 30%. So keep an eye on it. There's a free trial. Check it out. But overall, here are my holdings. You can see the percentage numbers. Obviously, this is also on the pie on, on Trading 212. It is all a real thing. It's all here. You can see certain things. You can see what I'm doing. Overall, the metrics, and for some reason it hasn't invested all the money, which I need to just press the rebalance button, which is totally fine. But yeah, it's all there. And that video was that long, my lights turned off. But I hope you enjoyed. Hope it wasn't too long for you. If you enjoy this sort of stuff, like, follow, subscribe. I will be doing an update in the next couple of weeks in terms of my new investments, in terms of how much money I put in the overall portfolio. It'll be a lot smaller, obviously, because I've done a whole deep dive. So yeah, enjoy.